What's up, everybody? Michael Silva here. Holy moly, we had 636 new lows today in the NASDAQ Composite, which is a record for 2023. This got us asking the question, was this the capitulation? Is the market going to move higher from this point? We're going to be answering those questions on today's Stock Market Brief Show, giving you key insights through the lens of technical and intermarket analysis. Look, there's a lot of macro data that suggests more weakness up ahead. There's a lot of geopolitical risk that also signals more risks ahead. We're going to keep it to key technical levels and keep it simple from longer term charts to smaller term charts to know when the trend may change. Let's get into it. Well, first things first, people. Bill Ackman was out today saying that they covered their bond short. Holy moly. What took place today with that news? Well, the 10-year yield backed off quite a bit. But it was also coming up to the edge of this upper technical channel that we've been mapping out. So it was down 1.75%, sending the TLT up a whopping 1.2%. I'm sorry if there's an echo, by the way, in this room. I'm in a new office, still have to put some furniture up and things. We're still in overall downtrend, but this price action was coiling up over here, and we saw a nice little breakout today. We had that positive divergence on both the RSI and the price percent oscillator. Oil also on this news backed out quite a bit, almost down 3%. Remember on yesterday's video, we talked about how oil follows that 10-year yield or vice versa. There's a very strong correlation between those two assets. So is oil going to catch a bid here, start bouncing up where we're going to continue to just kind of channel up, or is it actually breaking down from this flag? You can see that oil broke down. Guess what was the worst performing sector? Well, energy was, right? Makes sense there. There's a strong correlation as well, down 1.62%. What led the way? Communication services and technology. What I do find interesting is utilities was down on the day and bonds caught a bid, and there's typically a strong correlation there. So maybe there's some opportunity into utilities. I'm thinking that maybe it was down because we do have a large utility name reporting before the market opens. Actually, these are all names from the S&P 100 that are reporting earnings tomorrow morning. And I'm giving you these expected moves. This is something that I shared with my Discord group, Patreon group. We got GE, GM, Coca-Cola, Dow, 3M, DHR, Verizon, NextEra Energy, and RTX all reporting. These are the plus or minus expected moves. This is what the market perceives, the options market perceive as a risk range going into earnings. Then you have your upper level, lower level, and I even include the two standard deviation levels, because if you think about this in terms of a distribution curve, 68% of the time it's going to close between the upper level and lower level. 95% of the time it's going to close between the two standard deviation level right there. So if you want those levels, just go ahead and download this chart deck or screenshot this screen. Taking a look at the dollar. The dollar also backed off. So most of the moves in the market today, I think that were really led by the movement in the yield. You can see this backed off quite a bit. The dollar was strong intraday. The S&P 500 was very strong intraday, but it did start to back off. The dollar never really caught too much of a bid, but it is still in this kind of compression pattern taking place. If we take a look at the heat map, yep, there was a lot of confusion. You can see energy names were the ones that were hit the hardest. Nvidia was up, that helped out a lot. Meta was up a lot. Those are the big market cap names that really drive a lot of order flow in this market. Now, the SPY on the daily time frame closed above the year-to-date anchored VWAP, but you can see we took out this low. So what does this mean? We got a high, we got a high, we got a high, we got a high. They all have in common one thing, all lower highs. And then we have a low, we have a low, we have a low, and now we have a new low. They all have something in common. They are lower lows. So the trend is down, and I want you to think of this year-to-date anchored VWAP really as a big shift in sentiment. If we really start closing beneath it, just take a look at the quarter-to-date, right? So when people were right here, it was down, but when we got above it, you saw this big burst of energy to the upside, right? This led us to believe kind of a change in sentiment. You got to understand, when everyone in the entire quarter, only from here, was in the green, the sentiment is more positive and you could get some bursts of momentum to the upside. On the flip side of that, take a look over here, right over here when we broke down. When it's telling us that we broke down here, that's telling us that the average person based off of time and volume is underwater. And if that's the case, people look to get out of positions and the average becomes more and more deeper into the negative. And then we see this boom push to the downside. Well, now we're over here at the year to date. So if you think of this as a pendulum swinging back and forth, here's the pendulum, whatever, and it's swinging over here and it's swinging over here, right? We are basically right here in the center at the year to date anchored VWAP. And if we start really breaking down from this level and it holds as resistance, the average person, based off of the time of year and the volume traded all throughout that in the SPY, becomes underwater. It could change sentiment to be a little bit more forceful to the downside. So we got to just be aware and open to potential more sell side if we continue to close beneath these levels. Other than that, let's go to the 15-minute time frame. I wanted to point out that, yes, we are still below the declining 5-day moving average. We're below the green line, which is the quarter to date. Today, we didn't really see, we saw some decent action. In yesterday's video, we said I'd like to see a gap down to the lower daily expected move and maybe see more of a flush. And then you could play that to the upside because the chart was already pretty beaten up to the downside. So to see some short coverings to move the market higher made sense. Now, we didn't start the day down there, but our thesis played out where we gapped down. We saw more of a push to the downside, and then we ripped. All right. But then all of a sudden, we started to sell back off, getting below the daily anchored VWAP. Now, going into tomorrow, we have a couple levels to pay attention to. We still have a wide open week of expected moves. Now, I showed you what was reporting earnings come tomorrow morning. After the close, we got the big mega caps reporting, which I'll try to share those expected moves with the Discord group, as well as I'll try to post them on Twitter too. If you don't follow me there, go ahead and follow me, or X, previously known as Twitter. If you want these levels, I'm not going to go over them at this particular time, so just download the chart deck so you can have a more close-up view of these key levels there. And so you know, they're daily expected moves, and then I include the 2 standard deviation moves for the day, and then I have the weekly expected moves there. Going into tomorrow, we do have some macro data that could potentially add more volatility to the markets. We get red book year over year, and that's before the market opens up. Now, 15 minutes into market open, okay, remember, at the very beginning of when a market opens, so 6:30 Pacific Standard Time, 9:30 Eastern Standard Time, at the beginning when the market opens up, you typically get a lot more volatility, right? Kids bouncing around like just insane moves, okay? Now, include that with some macro data, 15 minutes after, we're going to see a lot of volatility in tomorrow's market. So what I like to do is I personally like to let the market digest, see what the market wants to do, see if it firms up, and then I'll try to execute any sort of intraday trades if I must. After that, we do have 7 o'clock Richmond Fed Manufacturing Index, manufacturing shipments, and a couple other things there, including the 2-year note auction at 10 a.m. That's Pacific Standard Time. Now, I want to go to this chart. This was on the thumbnail. I thought this was interesting, so I might as well share it. But, we're getting a lot of fear, right? We have lower lows, lower highs. The trend is down, okay? But the same thing happened over here in going into March, where we saw a high, a lower high, a lower high. We saw a low, we saw a lower low, and lower low. But then we started bouncing and we moved, significantly higher, okay? So I thought this was interesting how we dropped about 10%, it was 9.2, or give or take a little bit more, right? I didn't accurately draw this out. And then we're about a 10% correction from this swing high here on the NASDAQ, showing the NASDAQ 100 beneath us, but I'm really charting out the up here is the NASDAQ Composite. Okay, now we saw this big burst of this green bar, which is highlighting the new lows in the NASDAQ Composite. And the NASDAQ Composite has 3,500, tickers somewhere around there. So it's a huge, broad market. And to see a big spike like this, they can potentially mark reversals. And as you can see, we saw this big burst right here, 636. The last time that we saw that was over here in March. It was this specific day, and that actually marked a turning point here in markets, and we started to rally up from that point. So I'm wondering here, hey, if this is some sort of capitulation, we've dropped about 10%, right, which is about a correction. We saw, a blowout move in new lows. So are things getting frothy enough to the downside to potentially lead us to a bounce? Now, this comes with a caveat, right? A lot of the times, crashes do occur at, extreme levels. So you always want to proceed with caution. But if you say, hey, I'm just going to say have a stop below the low of today's candle, or, if it closed below this, then I'm going to okay, I don't want this trade anymore. I'll see how it firms up. And then if it bounces all the way up to here, well, your stop was down here and you played it up to here. So there's a good risk to reward as long as you're really focused on that risk first. Now, if I look at the bullish percent index for the NASDAQ Composite, we have a low and a higher low reading on the RSI. We also have a low and a lower low reading on the bullish percent index itself, showing that there is a positive divergence in the works as it stands in this current moment. And this is a low that we haven't seen dating back to really the start of 2023, where we pulled down, we got into oversold conditions, and we bounced from that level too. So it'd be interesting to see if this can start turning back up, and then we could play a little bit of a bounce to the upside in this broader market. BPSPX chart did move back into oversold condition, and that's also almost forming a positive divergence, as we have about matching lows right there, just about. And then we have a much stronger than previous RSI, and you can see also we have that new low there in the S&P 500. So that's also shaping up to be into that oversold condition. Now the NASDAQ bullish percent index is the same situation. We have a low, a lower low. We have a low and a higher low in the RSI. So we have a positive divergence currently in the works forming right there. We've seen these play out before to the upside, right? This was almost one right there. I would consider that, pretty close to a divergence, and we played it to the upside. It was definitely an oversold condition. And remember, oversold can stay oversold for a long time. It's been kind of chopping around oversold for a while here, and overbought can stay overbought for quite some time too. If we look at the S&P technology sector bullish percent index, I wanted to call out that we have a low and a lower low now, and we have a low and a higher low here. So as it stands in this current moment, as we're going into some big tech earnings, we do have a positive divergence forming on the bullish percent index. The last chart I want to really close off here is just looking at the percent of stocks above the 200-day moving average. Now, there's a lot of lines on my chart, so I'm going to break it down for you. Okay, we have the NASDAQ Composite, the NYSE, the NASDAQ 100, and then all these are different index products. So the S&P 500, small, mid, S&P 1500, which includes all of them, S&P 100, and Dow Jones. Okay, and then it's telling us these lines. These lines represent the percentage of that index, how many stocks are above their 20-day moving average. Okay, so when it's down here, right, so we're looking at S&P 500, it's down all the way here, giving us a 17.8 reading. So that's telling us that only 17% of stocks, almost 18, in this S&P 500 are above their 20-day moving average. So that means we're getting into some oversold conditions, right? When we get into these oversold conditions, they're not really there for all too long, and you can get bounces from those levels. The most recent one we discussed was there at the October bottom, okay? And if you take a look over here, the small caps, only 15% of stocks in the SP 600 are above their 20-day moving average. So this is 600 small cap stocks. The mid caps, only 11.75% of stocks are above their 20-day moving average. And you can see this is a pretty oversold condition. The last time we were there was in October. Okay. And then the 1500 is also getting to a pretty critical reading, only 15% of stocks there as well. And then when I look up here over at the NASDAQ Composite, that's the one that we kind of focused in on as far as those new lows go. We're getting a 17.88% of stock, and that is a large, broad market. And you can see this is a low that we haven't seen since October. And prior to that, it was where? It was that March bottom, kind of lining up right around this time where we saw a big spike in new lows. All right, people, that's all I got for you on today's episode. It looks like we could very well be in for a potential bounce as things are getting to this oversold condition, but you be mindful of these key levels, including the year-to-date anchored VWAP, and be aware that we are still in that current downtrend. So if you want to wait for price to get back above the 5-day moving average and for it to start flattening out and curling back up, that is completely and utterly understandable. You want to see a series of higher highs and higher lows on the smaller time frame charts in order to make sure that we can start moving up higher. Okay, that's all I got for on today's episode, everybody. See you later.